Hi everyone, and welcome to our client webinar titled Seizing Income Opportunities in Volatile Markets. Before I begin, a quick overview of our agenda today. My name is Howei Folk. I will first talk about macroeconomics, followed by how one should construct portfolios to navigate the uncertain markets today, which include the risk of recession as well as heightened inflation. Daryl Ho from our Chief Investment Office will share on the bond markets and why they are offering high income generating alternatives today. Jake Fu from the Discretionary Portfolio Management team will share some investment expressions you could gain exposure to for a resilient portfolio. And we will have a Q&A session at the end to answer any burning questions you may have. You will be using Pigeonhole for our Q&A segment. You can scan the QR code or go to dbs.pigeonhole.at and enter the passcode DBS CIO 23. You can enter your question and also vote for questions you want answered. First, the current market overview, which today is showing us conflicting signals. The chart at the upper end, inversion of the yield curve as represented by the difference between a 2-year and a 10-year treasury yield, is really a harbinger for impending recessions whenever the yield curve is inverted. In other words, when the short end of the yield curve is higher than the long end of the yield curve. And in the past, as shown during the oil crisis of the 1980s, the pre-internet bubble bursting in 1999, and the GFC in 2008, whenever there was an inversion of the yield curve, an impending recession would take place. Today, the yield curve is highly inverted, acutely inverted, which suggests really a hard landing scenario in the making. However, looking at the graph, the chart below, the credit spreads, which is really a measure of default risk, suggests a more sanguine view. When compared to the much wider credit spreads in the past, that has been followed by hard landing scenarios, current credit spread point not towards a hard landing, but rather a soft landing. Our baseline view is that of the latter. A soft landing is ahead, given economic data recently points to a continued resilience in the US labor market and corporate earnings. Another reason why we believe there is a soft landing in the US is that US households are in a much better shape when compared when they were in previous downturns. And because US GDP comprised some 70% consumption, the relatively stronger financial health of US households will support economic growth to the extent that a hard landing or a deep recession is really not our base case scenario. Hence, we advocate for investors to be engaged with risk assets of bonds and equities. With the uncertain factors in play in the markets today, how do we pick the best performing asset class to invest in? Now, this is a diagram to simply show that it is almost impossible to spot any one asset class, be it equities, be it bonds, REITs, that will perform the best in any single year. You can see that in the returns of the various asset classes. They are sporadic and random. For example, REITs, Real Estate Investment Trust, did very well in the early 2010s, but now they were the worst performers in the early 2020s. A diversified portfolio remains key, as we all can't time the bottom perfectly. So the best approach to constructing a positive yielding, at the same time resilient portfolio, is to have a balanced policy of bonds and equities. In DBS, we call this approach the barbell strategy. Anchored on growth and income, this strategy helps capture superior returns from long-term, irreversible growth trends on one end, while generating stable income on the other to mitigate short-term market volatility. Let me elaborate on the growth end of the portfolio construct. Today, the bar for earnings growth is really not low. Investment-grade bonds are yielding 6% today. And if we were to attach a historical risk premium of 3% to equities, it means equity earnings growth must be in excess of 9% before it becomes more attractive compared to bonds. Looking across all sectors of the market today, it appears most do not clear this 9% bar. Mainly growth sectors like technology-related equities do. Why? Because these companies in this sector ride on this secular theme of the world becoming a digital economy, such as the recent innovations from AI. And that will ensure such companies to deliver double-digit earnings growth, thus meeting the 9% bar that is posed by investment-grade bonds. Now, what constitutes these kind of companies that ride into secular theme of the world becoming a digital economy? At DBS, we came up with this acronym I.D.E.A, I-D-E-A. I stands for innovators. Companies like Apple, the most innovative company in the world. D stands for disruptors, disrupting the status quo of how business operates, such as Amazon when it disrupted brick-and-mortar retail businesses. E stands for enablers, really the brains that enable the digital economy, the likes of semiconductor companies, the NVIDIAs and the AMDs that really create very complex semiconductor chips to empower artificial intelligence, for example. A stands for adapters, really traditional companies that are able to adapt and capitalize on this digital economy. A good example is Walmart in the US with its e-commerce channels on top of their brick-and-mortar retail stores all over US. But right now, let me pass the presentation over to Daryl to talk about the interesting opportunities for the income-generating part of the barbell portfolio, that is bonds. Daryl, please.
Right. Thank you, Wei Fuk. Hi, everybody. Again, I'm Daryl. I cover fixed income strategy for the CIO office. And I just want to reiterate what Wei Fuk says, right? Bonds are today really a fantastic asset for income generation for all your portfolios. But I think I can understand what investors are feeling and thinking. Yields are volatile, right? Default rates could be rising in the case that a recession does come into play. So investors who are unfamiliar with bonds can sometimes find it quite intimidating to go into this asset class. So this is why we at DBS, we came up with the Liquid Plus strategy, right? To help investors navigate this tricky environment. So the strategy focuses on short tenor bonds, which helps to minimize the interest rate sensitivity of your bond portfolio. And also it focuses on investment grade credit, which minimizes your exposure to default risk if the environment does slow down economically in the future. All right, so this mitigates a little bit of some of the common sources of risk that you see in a bond portfolio. And you will see that even with such controlled risk-taking under the Liquid Plus strategy, it is expected to still yield between 5 and 6% today, which is a very healthy level of yield, which is why we are very excited to share with you this strategy. So without further ado, let me go into a little bit on what's happening in the markets. So if you look at the chart on the left in this screen, credit markets are just in short, cheap relative to their 10-year history, right? So if you look at the bar charts, this is really the range of where the credit yields have been trading over the last 10 years, and the line represents its 10-year average. So you will notice that the orange dots, which is where the present yields are kind of pushing against the upper boundaries, right? It's setting new highs today, which tells you that against its own history, bond yields are cheap, right? You also look at the chart on the right and compare, and you see that the orange line representing investment-grade credit yields have opened up a gap over equity dividend yields to a size that we have not seen really in the last 10 years. Again, so when you compare it against another asset class like equities, bonds again look like they offer very favorable income generation, safe income generation. So whether it's against its own history, against another asset class, the bonds still look like they offer value. So a lot of this has to do with the Fed hiking cycle as we had known in 2022. But where are we now today? Right, so here this chart here illustrates where we are or where we think we are in the policy cycle, right? If you look at a typical cycle, usually you go through an early phase, a mid phase, a late phase before we enter into a recession, right? So the early phase of an economic cycle is usually where you see activity rebounding, credit is beginning to grow, monetary policy is stimulative, right? So if I were to bring your attention back to 2020, that was kind of the environment that we're in. And back then, I think Wei Fuk was calling towards an overweight in equities because it is precisely the part of the cycle that equities would do pretty well. And you know, as time would show, that was really the best time to be engaged with the equity markets. Right, and then we come towards the mid-cycle where growth starts to peak. Credit growth is still quite strong. Monetary policy is quite neutral, right? And that's where there's some developments in the commodity space where you see commodities start to outperform. And in the CIO office, we've also talked about commodities last year in May, and kind of suggesting again that's the part of the cycle that commodities usually do quite well. And then you come towards the late cycle where growth starts to moderate a little bit, credit conditions tighten, and of course monetary policy reaches one of the tighter levels in its cycle. And that's where we are, where we think we are today if we look at the economic indicators. And if history is right, this is around the time where going overweight in bonds would stand you very well in your portfolio, which is why for the fourth quarter as well, the DBS CIO office had looked towards an overweight in bonds in line with where we think we are in this cycle, right? And you look at the chart over here, right? Where are we? Are we really late cycle? I think the Fed has also kind of agreed on that, right? If you look at the chart on the left, you will see the very rapid ascent of rates in 2022. One of the quickest, largest changes in interest rates that we've seen in recent times. But the good news is that we are late in the policy cycle, right? If you look at the dotted lines forecasting where interest rates are going to be in the next 2 or 3 years, the white line represents where the Fed themselves project interest rates will settle. And you will notice that these dotted lines no longer are extending upwards, right? In fact, it is flat and lower. So this projects that in the next 2 to 3 years, they do anticipate the interest rate environment to come down and rate cuts to come into play, right? And the extended dotted orange line also tells the same picture. This is what the Fed Funds Futures market predicts, right? It's a predicting projection. And they also think that interest rates have kind of peaked out and will start to fall slowly in the years to come. So in both cases, the projections of interest rates seem to suggest that we are close to the peak of the policy cycle today, right? And if we are close to a policy pause, this generally does not bode well for your cash deposit rates, right? So if I were to draw your attention to the chart on the right, the gray lines on this chart represent periods in history over the last 35 years that the Fed also paused in their monetary policy. And you will notice that cash deposit rates referenced by the orange line very, very precipitously start to fall after the pause in the Fed hiking cycle, right? And this has happened multiple times, 6 times in exact over the last 35 years. So if you are an investor today enjoying your high returns on cash, just be careful, the good times may not be around for far too much longer, right? Let me show what it looks like in numbers. So what we did on this table is to extract each of those 6 occurrences where the Fed decided to pause in the hiking cycle in 1989, 1995, 1997, 2000, 2006, and 2018. And you'll notice that every time they paused the interest rate hiking cycle, it was because there was some form of emerging concern that happened when the economy started to slow down, right? There were various reasons, but it's always because economic numbers started to fall quite quickly. And today, we are also seeing inflation growth kind of follow that same trajectory. So what I want you to pay attention to is that whenever the pause happens, there will be a subsequent change in cash interest rates, right? If you look at all 6 instances, we took an average, and you'll see that on average, cash rates will start to decline by 3.5% over the next 2.4 years, right? Which is not a very long time, right? You can see cash rates start to decline quite rapidly after the Fed pauses in the interest rate cycle. And so this is why we say, if you're sitting on cash today and it's earning you good interest rates, be careful, because sometimes, if history is right, that the time to enjoy it is quite short. On the flip side, in the same time that these cash interest rates are going down, you'll notice that the column on the right shows you that annualized investment-grade credit returns are actually quite decent, to the tune of double digits in certain aspects, in certain instances as well, right? And this is a result of a combination of your coupon yields and, of course, price gains, because bonds tend to respond very positively when the interest rate environment starts to decline, right? You get some price gains, you get some coupon yields, and that in total represents why you can get returns that are quite favorable, and again, speaks to why we're positive on bonds at this point of the cycle. So the biggest question we always get from clients is this, why not just stay with cash or deposits or T-bills when rates are so high, I would say that we do not advise it, because history seems to suggest you do the opposite of that, right? So if you look at this chart, this is the Treasury bill yield, 3 months T-bill yield, minus the investment grade credit yield. And yes, in history, there are times where these two yields look very similar. And the thing you'll notice about this chart is that every time they look very similar, some sort of crisis occurs, right? So in 1999-2000, when these two yields came close, we were met with the tech crisis, which forced the Fed to cut interest rates, and therefore cash rates didn't stay high for very long. Of course, very famously in 2008, we saw the financial crisis, which again was a very brief period where cash rates and investment grade credit were the same, and then cash rates started to be slashed very dramatically towards the zero bound. So when these two yields coincide, it doesn't last very long before some form of stress occurs, right? And after that, your cash rates are no longer high. And so history informs us that every time you have cash rates that are close to bonds, history suggests that you should be better off in bonds in the years that follow, right? So again, I know that yields on cash are attractive today, but if we were to let history be our guide, bonds look like a good bet. Next, we want to go into a little bit of the nuances of the liquid plus strategy, okay? So why do we choose short tenor bonds? This chart here, we show the sensitivity of bond price changes to interest rate changes, right? I think we know from financial theory that if interest rates rise, represented by the x-axis, bond prices start to fall, which is represented by the y-axis. So if you notice on this chart, the longer the bond tenor, the higher the sensitivity, right? So the light blue bar is the 30-year bonds, and the dark blue is 10-year bonds, orange line is 2-year bonds, right? You notice the higher the tenor of the bond, the more sensitive it is to interest rate changes. So just to illustrate an example, right? Long tenor bonds this year have fallen 20%. From June to October, in just the recent few months, the drop alone was 16% of that 20%. So this is the sensitivity that I'm talking about. And this is not the type of volatility you want in a stable part of your portfolio, right? And this is why we, and in the liquid plus strategy, prefer short duration bonds. And while the interest rate environment is very volatile, this will help you for two reasons, okay? The first reason is this. If you look at the chart on the left, you will notice that the interest rate curve is inverted, right? That means that the short end interest rates are comparable, if not higher than what you are receiving on the long end. So that means that you don't actually have to stretch out your duration or your tenor very far to get the same yield, right? Again, if you remember the chart before, because the longer tenor bonds are more sensitive to interest rate changes, you don't have to take that risk, right? And so short tenor bonds offer you very attractive yields today. Next, if you look at the chart on the right, the short tenor bonds give you a very good margin of safety. So what do I mean by that? If you look at the orange bars here, this represents the type of coupon yield you're getting on bonds of various tenors. And you will notice that all of them are right around 5 to 6%. But if you look at the blue bars, this represents the price risk you have if interest rates rise by 1%. And you will notice that in the 1 to 3 tenor bucket, even if interest rates go 1% higher, you will still get total returns of around 4%, which is still largely positive, right? And so this is what I mean by short tenor bonds and why the Liquid Plus strategy focuses on short tenor bonds, because you have a margin of safety and you can manage strong positive returns even if interest rates unexpectedly go higher from here. So what we did is we took this 1 to 3 tenor bonds and we stress tested it further. Okay, so what we did is we looked at this table where you will see that on the horizontal part of the table, you'll see that we looked at a different set of changes in interest rate environment against the duration buckets, which is on the left side of the table. And if you look at the 1 to 3 year bucket of bonds, notice that interest rates can go all the way up to 150 basis points higher, and your total returns in this short duration segment is still not negative, right? So again, this short tenor bond bucket is a very insulated portfolio against the volatility of interest rates that you're seeing today, right? It will take way more than 150 basis points to cause you to have negative total returns in a 1 year time frame. Conversely, if the interest rate environment starts to decline, as the Fed themselves are projecting in the next 2 or 3 years, the investor can not only just anticipate your coupon returns of 5 to 6%. In a declining yield environment, you can also look forward to a little bit of capital appreciation on your underlying bonds, which towards the left side of this table seems to suggest that total returns of 7% is not surprising if the interest rate environment starts to decline. Next, we talked about duration risk. Now we want to talk about credit risk. You know, why do we prefer investment grade in the single A, triple B space? Again, this is simply because of their low default rates, as represented in this chart by that orange line just above the x-axis. So today, if you read the papers, if you read the news, there's a lot of recessionary fears. And recessions generally lead to a pickup in high yield default rates. If you look at the white lines represented here, every time you see a recession period, which is represented by the gray bars, you will see that high yield default rates start to spike up, sometimes as high as 10% and above. Investment grade default rates, if you notice from this chart, is usually very low across the cycle. Right? In 1989, during the savings and loan crisis, the default rates only rose to 0.2%. Right? Similarly, in the 2002 tech crisis, 08 financial crisis, default rates also peaked at 0.4%. Again, this is not large relative to the yields of 5 to 6% that you're getting on these bonds today. So if you look at investment grade credit, they have undergone some of the worst economic outcomes and is still able to provide you some stability for your income generating portfolio. So the market understands, I think, the risk in credit today. So if you look at these two charts over here, 2022, the rate hiking cycle was really really one of the worst for bonds in terms of fund flows. So if you look at the white lines, there was a drawdown in bonds. Fund flows were generally exiting bonds in the whole of 2022. But come 2023, there has been a reversal. Notice that investment grade bonds have more than recovered from their 2022 outflows, represented by the orange line in the chart on the left. But from a technical perspective, the high yield bonds, if you look at the chart on the right, the red line still shows that year to date, high yield bonds are still struggling to recover from the outflows they saw last year. So from a technical perspective, this bodes well from a demand standpoint that investors are looking at high quality bonds as part of their portfolio, income generating portfolio. And really this demand is a good technical support for this space in the next few years. So I will just come up with my key takeaways from my presentation today. If you look at the chart on the right, looking at investment grade yields in the 1 to 3 year short tenor segment, the yields are 5 to 6% again. And if you look at against history, this is more than 2 standard deviations higher from its 10-year average, right? Again, very attractive, higher even than in the COVID crisis when everything was being sold off dramatically. So the point is, the window of opportunities in bonds is still open, right? We may have looked at this year in 2023 and thought to ourselves, yes, I may have missed a little bit of the equity run, but again, the opportunity is still open with bonds. If you look at the yield chart today, you're still getting some of the highest yields you've seen in a long time. The second point is, being invested in a credit liquid plus strategy gives you diversification. So in a credit diversified portfolio, you are no longer sector concentrated, right? If you were putting your money in deposits alone, don't forget that there is ultimately still a concentration risk in the financial sector, right? So this enables you to have exposure to various other sectors that have different betas to the market and gives you better robustness for your portfolio. Third point, liquidity. In an uncertain and volatile environment, it's important to have some liquidity to capture opportunities when they present themselves, right? If you're purely in locked up deposits or T-bills, you are locked up for 6 months, 3 months, and usually you can't act quickly enough. In a credit exposure, a credit diversified exposure, you're able to liquidate in and out very quickly to respond to market environment changes, and that's why the Liquid Plus strategy it has it in its name. Being liquid allows you to stay nimble, right? And finally, it's insurance. In the case of a recession, right, not the base expectation of a hard landing, but if a recession does materialize and interest rates need to go lower, the bonds in this portfolio would naturally drift higher in terms of capital gains because bonds tend to gain in a lower interest rate environment, right? Deposits alone do not face capital gains. So I think with all this in summary, we can't reiterate much further, right? We do think that bonds are a very attractive asset class for income generation for your portfolio. And with that, I'll pass the time now to Jake, our portfolio manager, who will give us a little bit more insight on a Liquid Plus strategy.
Thank you, Daryl. So Wei Fok and Daryl have brought you through the Liquid Plus and the I.D.E.A strategies, which are here to help our clients navigate these changing times. Here at DBS, we have put together some fun examples for you to tap into the expertise of our Chief Investment Office for more robust portfolio construction. So on this slide, you can see the risk-return spectrum. As we understand, as investors, the more risk you take, the more risk potential return you can earn. On one end of the risk-return spectrum, we have the DBS CIO Liquid Plus Fund. This is a pure fixed income fund that seeks to deliver to our clients the best of both income and liquidity. Now, on the other end of the spectrum, risk-return spectrum, we have the DBS I.D.E.A Fund. This is an example of the growth side of the barbell strategy that Wei Fok has been advocating for. It's a pure equity fund that seeks to generate capital appreciation. We invest in the best-in-class industry transformative stocks that will deliver long-term growth to our clients' investment portfolios. These are two fun examples that are available for our clients. To understand what is best for you in your portfolio, please do reach out to your relationship manager who can best advise you on the next steps to achieve your financial goals. Wei Fok has shared a lot about the I.D.E.A framework to picking winning companies that we incorporate in the I.D.E.A fund. We have a strategy, we have a website dedicated to it. For more information on the I.D.E.A strategy, please scan the QR code on this slide and you can check out more information on the website. Alternatively, you can also contact your relationship manager to learn more about the I.D.E.A fund. Are we spending more time talking about the DBS CIO Liquid Fund to kind of amplify the message that Daryl has shared about the income opportunities in the market today? But first, let's watch a quick video.
Some believe market volatility means uncertainty, but we see opportunity. With the DBS CIO Liquid Fund, refresh your portfolio with a mix of high-quality corporate bonds and low-risk government bonds. You will have the optimal blend of safety, liquidity, and yield.
So the DBS CIO Liquid Fund invests in the global bond markets. By investing in the global bond markets, we can deliver a diversified and robust portfolio for our clients, and at the same time deliver a high portfolio yield for you and our investors. Portfolio yield currently is 5.78% as of end August. Right now, the portfolio yield is actually even higher, in excess of 6%, and we think it makes this a great opportunity for income seekers today to put some of their capital to work. From the coupon income that we receive, we then pay out a distribution to our investors. That this will be 4% for the Sing Dollar share class, Sing Dollar H share class, and 5.5% for the US dollar and Hong Kong dollar share classes, respectively. Now let me just run through the investment process on how we construct the Liquid Plus portfolio. This slide here shows you some of the key considerations we take into account in building this portfolio. We add value through both top-down as well as bottom-up strategies. Now, top-down involves identifying the best segments to be overweight in from either a geographical or a sector perspective. Now, duration is which part of the yield curve we want to be positioned in to extract the best returns. For this portfolio, it ranges from a minimum of 1 year to a maximum of 3 years, keeping to the short duration tilt that Daryl was talking about earlier. Now, for example, if we believe that interest rates have peaked out, going to decline going forward, what we can do for this portfolio is to maximize the portfolio duration closer to the 5-year mark so that we can deliver more attractive returns for our investors. Now, vice versa, if we think interest rates are going to go a lot higher from here, we will reduce the portfolio duration. Now, one thing to highlight on this slide is that the portfolio construct, the overall portfolio logic for this fund is that it's meant to be a conservative product offering. Now, we seek to deliver the best returns for our clients, but overall, we're not in this to deliver very aggressive 20-30% type of returns for our clients. At the end of the day, we have a conservative, a risk management mindset to portfolio management. Two things to highlight. The portfolio is mainly invested in the developed markets, US, Europe, and Japan, for example, some of the developed jurisdictions of the world we invest in. 70% of the portfolio, at least 70%, will be invested in these regions. Credit quality is something we also think about. We invest across the range of credit quality available in the market today, from AAA all the way down to the BBB in the investment grade space. There is some allocation to high yield, double Bs, but here we pick the best-in-class companies in the high yield segment, those that we think have the potential to move up higher and go into investment grade, which helps to deliver a little bit of additional return for our clients. Portfolio construction, moving from the top down to the bottom up. Bottom up is all about individual security selection. We work in-house with our in-house research partners as well as external research partners to source for the best-in-class credit research. And here we analyze each company one by one, looking at their credit metrics, things like your gearing, your interest coverage ratios, their business competitiveness, the industry, earning stability, as well as other financial metrics that are really key to evaluating the health of a company. Next, we then think about entry levels to when do we think is the best time to get into and exit the identified securities and progressively mold the shape of the whole Liquid Plus fund, the shape of the entire portfolio. The Liquid Plus portfolio, the Liquid Plus fund, has in excess of 150 single line bonds spread across various industries and countries. This, we believe, is the optimal approach to harnessing and harvesting alpha or incremental returns for our clients, and at the same time ensure that the portfolio is resilient. You can see some of the other key metrics that we think about. Our track record in terms of security selection has been pretty good so far. This year, we've managed to avoid the high-profile default or distress situations that you might have read in the headlines this year. The likes of Adani, Credit Suisse, Silicon Valley Bank, and Country Garden, we have had no exposure in the portfolio, so we have navigated the uncertain times quite well. Here you get to see some of the key themes, some of the key thought process that goes into building the Liquid Plus Fund. We want to share with you some of these top-level kind of thinking and the key areas to which we look to invest in. First theme that we have starting on the left is the state-owned enterprises. Here we are invested in the likes of Electricity de France, ChemChina, REC in India, and Pertamina in Indonesia. What these companies have in common is that they are all companies that are majority owned by central governments around the world: France, China, India, Indonesia. These companies are not just majority owned. That does not just make them safe by definition. They also play a very strategically important role in their domestic economies, whether it is in the chemicals industry, the utility sector, or the oil and gas sector, making them absolutely important to the functioning of their domestic economy, as well as making the likelihood of support from the government extremely high. Next, we have expressions in technology, including semiconductor companies like SK Hynix and Micron. Hospitality and tourism we also like. Companies in this category include Expedia, Genting, and of course banks. Banks will always be a key focus for the bond markets. And here we look for the best-in-class global banks, national champion type of banks, the likes of Bank of America in the US, Westpac in Australia, and ING. Here you can see, this slide shows you a little bit more information on the portfolio allocation of the Liquid Plus Fund. Now, I'll leave this here for you to take a look at, but two things I really want to highlight. First, the portfolio is very diversified in the geographical and industry allocation. This is something we pay very close attention to in portfolio construction. This is absolutely essential to make a robust portfolio stronger. Second, the conservative tilt of the portfolio, as what Daryl has been talking about just now, leads us to allocate a pretty low allocation to high yield currently at just 4 to 5% of the portfolio. Now here we've made selected targeted bets in companies that we think are really strong, the likes of Hilton, the likes of Delta Airlines, where we think there is a chance that as they benefit from the reopening story, the resurgence of tourism playing out in the US, they could benefit more and emerge even stronger. But overall, the key message I want to share with you today is that the Liquid Plus Fund and the Liquid Plus portfolio is intentionally skewed more conservative to handle the current challenging market environment and to deliver to our clients that sustainable returns. Next, we'll be moving into the Q&A section. We'll be using Pigeonhole for the Q&A section. You can scan the QR code or go to dbs.pigeonhole.at and enter the passcode DBS CIO 23 to enter your questions. Wei Fok, over to you.
Right, thank you. I have been receiving quite a lot of questions, and let us try to address some of them. The first being, Singapore REITs have slumped. Are they a buy or sell? How badly will their profits be hit by high interest rates? So that's true. Singapore REITs have come off a fair bit. Today, because of the price depreciation in the order of 10 to 15%, the dividend yield is in the order of 6 to 6.5%. And that clears it's attractive vis-a-vis bonds. I mean, we were seeing bonds are in the region of 6%. So we think REITs have a place in our income-generating part of our barbell portfolio. Unlike US REITs, in the area of commercial REIT particularly, Singapore's REIT market is a lot different than that in the US. The occupancy rates in the commercial sector, in particular the grade A offices, still remains very, very high. So, in the construct of REITs in the income part of the portfolio, we would advocate that, you hold on to commercial REITs, the high end of it. We also advocate for a spread across hospitality, retail, as well as industrial. I think not unlike bonds, you want to have diversification, but buy into the strong, I would say, sponsored REITs in Singapore. The dividend yield, we think, is very sustainable. Leverage LTVs on these REIT companies are manageable. They are rather low, in fact, and the tenor for their loans are actually quite well spread, and it's pretty long. So we do not think they are necessarily a headwind, and a dividend at 6% or more, I think, is a sustainable yield. So we like that on top of all the investment grade bonds that we have been showcasing here. As a very strong, I would say, income generating expression in our barbell portfolio. Okay, we do have a couple of interesting questions. I want to take this one up with Daryl. What are the advantages of having a portfolio of many bonds? Wouldn't it be better to target a smaller portfolio of high quality bonds instead?
Yeah, I suppose this question maybe references the strategy sometimes you adopt when you are investing in equities, right? And I think the idea here is that if you buy into just really 10 good companies, right, and you don't dilute kind of like the gains that you may have, because you are picking winners, you don't want winners to be diluted by the average performance of the others, right? So I think that's a good equity strategy. When it comes to fixed income, I would say it's a little bit different, because equities generally you want to pick your winners, but for bonds you want to avoid your losers, right? So if you have 10 bond counters in your portfolio, if by some accident one of them defaults, that means that on a portfolio basis, 10% of your portfolio is at risk versus a coupon yield of 5 to 6%, right? So your downside is kind of higher than the yearly annual coupons that you can anticipate to have. So the idea, and strategically, that looks like it's a very disproportionate risk for the returns that you're expected to get. Which is why, from a bond strategy point of view, you always want to be even more diversified. Say you have 100 bonds, right? If any one particular company defaults, only 1% of your portfolio is at risk. And when 1% of your portfolio is at risk versus a potential coupon income of 5 to 6%, that looks like more favorable risk reward, right? So when you're investing in bonds, in equities, for example, equities, yes, pick your winners, right? Concentrate on your winners, let your winners run. This is very good equity strategy. But from a bond perspective, we need to change our hats a little bit and think about where's our risk, right? And so if we broadly diversify that risk, especially when the broad market is still of investment grade, is offering you 5 to 6%, when you hold it to maturity, no one company will outperform another, right? Your returns will land at around the 5 to 6% mark in coupon returns. So I think with that perspective, when you're investing in bonds, it's always better to be much more diversified in your portfolio holdings.
All right, thanks, Daryl. This is for Jake. The question is, what is the yield investors would expect to receive from investing in Liquid Plus? And is the current payout sustainable?
Right. So the distribution yield on the Liquid Plus fund is 5.5% for US dollar and the Hong Kong dollar share class, and 4% for the Sing dollar currency hedge share class. We think this distribution is going to be in place over the next 12 months, which we think is going to be a sustainable level of distribution for our investors. Now, the main reason for that is because, as Daryl alluded to just now, the interest rate environment is likely to stay higher for longer. The Federal Reserve is unlikely to cut interest rates until possibly the later half of 2024. So over the next 12 months, we expect the income distribution potential for this portfolio, this fund, to be quite sustainable.
Okay, thanks, Jake. This is for Daryl. Why invest in short duration bonds over long duration bonds?
Yep. So if you noticed the presentation earlier, short duration bonds have a lot less sensitivity to changes in interest rates. So for example, let's take a very recent example. If you look at what happened with 10-year or 30-year bond yields in the last 2 months, you will notice that those yields have risen very, very dramatically with risk events such as a higher potential inflation, or perhaps a risk that the US government is printing a lot of money, and therefore long duration bonds in that sense are at risk. You see, the type of the exposure you get on long duration is really not to be trifled with, right? So just from June till today in October, long duration bonds already lost you 16%, right? That's 3 years or more of coupons, 4 years of coupons, right, in just a few months. So that sort of risk reward in long duration doesn't look appealing to us, especially when you can get the same coupon in the 1 to 3 year bucket, right? So if you think about risk reward in that sense, when you're investing in bonds, it's always better when there's this much uncertainty on inflation, on the trajectory of US debt sustainability and all these other risk factors, to think to yourself that if I could get the same coupon yield on the short end, and perhaps sleep easy at night, because even if interest rates go higher from here, my portfolio value is not impacted to a great degree. I think this is where an investor in bonds has that mentality, right? You invest in bonds not for your tremendous upside gains and potential for that. You're investing in bonds because you want a part of your portfolio to take care of you in terms of its capital stability and as well as ability to generate consistent income. So with that regard, short duration bonds would serve that purpose, right? The purposes of stability in price changes and the stability in terms of how regular it pays its coupon dividends.
Okay, thank you, Daryl. This is for you, Jake. What is the Liquid Plus fund's exposure to China? Will there be exposure to China property?
Yes. So to answer the second part of the question first, there is no exposure to China property in the Liquid Plus portfolio. And as a result, we haven't had to go through the whole drama that we saw in terms of defaults in the whole China property sector. There will be some exposure to China in the Liquid Plus fund. This section here, we are really focused on quality. The quality parts of China are still doing well. Just to give you a little bit of a sense as to where we think quality lies in China, is in two segments. One is on the state-owned enterprises that we talked about earlier, the likes of ChemChina, the likes of Sinopec, the big boys in the Chinese economy that play companies that play a huge role in the domestic economy. Second part that we really like in terms of China is also in the investment grade side. It is in technology. That portion has been under a lot of pressure in 2022, but as we have gone into 2023, the regulatory overhang on the sector has eased. And as a result, we've added on to positions in this sector progressively. In the likes of, to give you a sense of the names, those will be the likes of Lenovo, Baidu, Tencent, and so on.
All right, Jake, thank you. I'll take this one. Which is better to invest in, Liquid Plus or I.D.E.A Fund, I.D.E.A Fund? Well, both are completely different kind of return objective. Liquid Plus is really a low-risk, income-generating expression of fund that will give you on a regular basis cash flows of between 5 to 6% regularly. I.D.E.A is a pure equity portfolio, so the objective is really capital gains, and over time, obviously, if you can, hold on to that position for a long period of time, then equity normally outperforms bonds. But the way to kind of construct the portfolio is they're both. Now, if you are a lower risk investor, your time horizon for investing is shorter, then I would suggest more into Liquid Plus versus I.D.E.A in your portfolio. So in the order of 75% Liquid Plus, 25% I.D.E.A. However, if you are a more aggressive risk profile portfolio, then you could be equally weighted, or maybe 60-40 is a good combination. 60% in I.D.E.A, stocks or fund, and 40% in Liquid Plus. So when you have that kind of balance, what's going to happen is, even if there are volatile market conditions out there, the volatility will be dampened by the fact that, on this part of the portfolio, you do get this annual cash flow, through dividends and through interest income on the holdings from, in Liquid Plus, to really kind of weather through, the ups and downs, the downdrafts rather in the I.D.E.A Fund. But over time, we believe strongly that, I.D.E.A companies are really, number one, high quality. They are cash flow generating companies, and they should, over time, deliver good capital gains. So it's really a portfolio comprising the two, which, we believe is ideal for any customer. Obviously, I want to reiterate, if you are, lower risk, then have a, 80-20, 75-25 kind of configuration, and then vice versa for a more aggressive risk portfolio. All right, we have a few more interesting questions here. Let me just pick a couple of them. Okay, this is for Daryl. Why invest in bonds when US dollar fixed deposit rates are so attractive?
Yep. So if you recall during the presentation, yes, I cannot disagree that fixed deposits today are giving you very good yields. So as any investor should have some of those, right? But we also cannot deny what history tells us, that every time fixed deposit rates are very close to bond yields, there's some sort of stress that happens in the economic environment, right? Simply because today's economic environment has very high debt levels. So normally in a high interest rate environment with high debt, that is not sustainable for very long, which is why in history, when we saw that happen, very quickly the Fed met with some sort of economic slowdown that required them to cut interest rates, which means that if you're holding your cash deposits at 5%, if the cutting cycle starts to come more quickly than you expect, the next time you roll over that deposit, it'll be 5%, then it'll be 4%, then it'll be 3%, right? And that means that your returns on cash will be diminishing over time. So that's the risk you have in your deposits. You should have some, but that's the risk that you will face. Conversely, if you have some bonds as well, you're getting the same yield. But if the interest rate environment starts to come down, if stresses prove to be too much that the economy enters some sort of shallow recession or deep recession and interest rate environment is cut, your bonds will not only give you that level of 5 to 6% income for a few years to come, but also you get capital gains because the declining interest rate environment would tend to be a support for bond prices, right? So I think there's a place for both. But again, if you recall during the presentation, we are kind of close to the late cycle in monetary policy, which always and often seems to suggest that an entry or an allocation into bonds at this point of time seems to stand you in a very favorable position within the next 2 or 3 years.
Okay, thank you, Daryl. For you, Jake, how does the Liquid Plus fund compare against a bond ETF?
That's a very good question. I think the kind of environment that we've been talking about is one where there are a lot of uncertainties on the horizon for on the macroeconomic side, and as a result, there is a lot of uncertainty as to whether or not default risk will rise, which company will emerge stronger. And at the same time, this year we've already encountered quite a number of situations where good quality, high-profile companies kind of ran into trouble. Now, what this kind of macroeconomic environment means for us is that going down the passive approach of investing into every single bond through a bond ETF might not be the best one, because what you want to do is to identify a manager, an investor who helps you to pick and choose the best-in-class companies that can help to mitigate the default risk in any portfolio. Think about the example of Credit Suisse, for example. This bond would have been present across every single bond ETF out there, while might not have been so for that of an actively managed fund like Liquid Plus.
So I would want to add to that as well. So if you think about ETFs in equity terms, you will notice that, say, the S&P is dominated by a lot of very large players, and that's a good thing because the strong do get stronger, right? And when you buy an equity ETF, that tends to play out in the ETF portfolio. But in a bond portfolio, the stronger doesn't really apply, right? Because if you think about it, if there are more bonds in this ETF, that means that it allows the more leveraged companies to take a dominant position in the ETF. And if you're more leveraged, it means you are a company with more risk. So the ETF structure, when it comes to a bond portfolio, it actually works in reverse, right? You actually get a concentration of a company that you don't want to be concentrated in, because an ETF is just a passive flow. There's no active management behind it. You will naturally aggregate companies that are highly leveraged because they have more bonds in the market. And so this is not a position you want to be in as a bond investor. You want some thought behind it to say that, hey, wait a minute, some of these companies are getting over leveraged and issuing too many bonds, and you want an active manager to say, maybe we should not keep investing in a company that is increasing its leverage that way. So I think an ETF structure will work negatively to an investor's outcome, and it's actually better to have an active manager look at your positions when it comes to bond investing.
Yeah, I think on top of that, ETF are passive investments, and it's really constructed to mimic what the market is. And at times, we want to select the duration. Like for example, in current times, we think the shorter dated bonds in the order of 2 to 5 years is the sweet spot in terms of risk reward. And we therefore, are actively managing the duration. We concentrate our holdings in this shorter end of the yield curve. Yield curve is inverted, so you're actually getting higher yield at the shorter end than the longer end. Whereas the ETF may have a duration that is mimicking the entire market, and the duration could be much longer than what we think is the best spot, sweet spot for where you want to be positioned in the bond market. I think we do have time for just about 1 or 2 more questions. This is an interesting one. Why do we still invest in US Treasuries despite the risk of a US default? Darryl?
Yeah, we do get this question a lot. And this is why we are concerned, perhaps with the long end, beyond 10 years in US Treasuries. Because when it comes to likelihood of sovereign default, in a normal case, if a country is able to print its own currency, it will very unlikely default in the near term, simply because it can print the currency needed to get by its refinancing troubles, right? So as we saw recently this year, just this year, the debt ceiling discussions, yes, it was quite acrimonious, but eventually they managed to lift the debt ceiling and life went on. So in the short-dated risk, especially in the 1 to 3 year treasuries, we are quite comfortable because these are paying you, again, this is the risk-free rate, right? It's paying you very healthy returns of now 4 to 5%. So there is a place for this in your portfolio for the short duration. But where the risk may manifest in terms of default risk or sovereign risk would really likely manifest in the long end, which is, again, partly why we saw the price action that we did over the last 2 months when Treasury started to sell off very, very aggressively, when the market started to note the Treasury issuance schedule come the end of this year, right? So this is again why the short duration strategy is playing out very well. Being short duration here, even with short duration treasuries, the price risk in this last 2 months was not very meaningful, right? I think you were much more at risk if you got into 10 or 30 year treasuries. So yes, in 10 and 30 years, it's uncertain whether the default risk for the US is going to play out materially, right? That's not sure, and therefore we do not touch that space. But in the 1 to 3 year time frame, we're quite comfortable that with the yields that you're getting on treasuries here, that the US is not going to face some sort of serious trouble on the short end. So I think this is where we're comfortable with, and this is why the Liquid Plus strategy works for this purpose.
Right, thanks a lot, Jake and Darryl. Our time is about to run out. I just want to conclude that the interest rate environment that we are in today, we have not seen it in the last 20 years because the Fed really aggressively raised rates from almost 0 to where we are today in excess of 5%. So I think it's a great time to take advantage of elevated interest rates. Deposits are great, but they do have this reinvestment risk, as when rates peak out and you roll over your deposit, lo and behold, the subsequent deposit rates will be a lot lower. So try to capture the opportunity in Liquid Plus, our strategy for investing in high-grade, well-diversified portfolio of credits in the 3 to 5 year kind of maturity, or 1 to 3 year kind of maturity. We think it's a sweet spot to really kind of harness yields that we have never seen in the last 15, 20 years. And with that, I just want to thank you for your participation and for your attention here for this client webinar. Thank you very much.